So I wanted to talk on this whole difference in conversation about money between generations and how
Yeah.
maybe my generation look at money differently to how your generation, the generation before that, would look at money and their habits, the ways they would spend versus invest, and how they view it. Starting off with sort of the conversations which may happen between friends and family. And I think certainly today money is kind of less of a taboo topic, and people will
Yes.
not totally, but people will talk about it sometimes too openly.
Yeah.
Other
Yeah.
times in a positive setting. And so I think it'd be cool to see how you've experienced that, if you've experienced that change over time at all.
I suppose the baby boomer generation, which is those people that were born following the end of the Second World War to around about the late 1960s, that's what you would class as the baby boomer generation. They were very much the generation that initially grew up with job security, without necessarily their own, I'm talking about the masses, their own retirement plan. However, that was because their retirement plan was almost provided for them with their job, that sense of a job for life. So the jobs that were created post Second World War were all very much stable, infrastructure, some kind of manufacturing, service sector. So there was less requirement for those people to learn how to cope with money or vast sums of money. And it was more about the kind of Dickensian sense of making sure you're not spending more money than you are receiving. So it was all kind of dealt with. So you received your pay, you probably had deductions which covered things like a little bit of private healthcare, but predominantly a pension scheme contribution, maybe a share save scheme, certainly post late 70s, early 80s. And then they got the net pay. So from the net pay, it was then very much about that's your money to spend on house, home, food, clothes, entertainment and holidays.
Interesting.
And I suppose the conversations then were limited because it was all about a basic home budget. That same generation, certainly the latter part of the baby boomers and then post the baby boomers, have then had to almost convert from that situation into a scenario where they have got to come to grips more with how they look after money. Because in the past, the big employers provided their retirement plans. Now they've got to kind of go it alone to a large extent. What I mean by that is the way that you save for retirement is different now to how it used to be, without going into the technical detail of that. But it does mean that you have to understand what your retirement plan or future prospects looks like in order to start to set money aside for that. So you might still have money deducted from pay if you're employed towards a pension, but it's nowhere near as positive and as wealthy as the older style schemes.
Yeah.
Because the same deduction on the older style schemes were combined with the employer kind of underwriting the income. Whereas now, the money that goes into the scheme now, it just goes into an investment fund, an investment pot. So the more recent generations have had to get more involved, more savvy with what that pot looks like, where that money is actually going, and how I'm getting a return on that money. Then you also have got situations where people have thought more about the net amount of money that they're receiving. Yes, they've got to deal with their month-to-month expenditure, but have they got money spare? And where do I put that? Do I just put it in the bank and save it? Do I physically invest it? the last 5 to 10 years, it's then also been about crypto and the younger people. So I guess all of that preamble is what I'm saying is there perhaps wasn't as much of a need to talk about money in the earlier period, whereas now you do have to discuss money. And I don't know whether it was a taboo subject or it was all sorted, it was dealt with. Everybody had got their situation was looked after, if you like, by both the private and public sector. Now we're very much in a generation, in an environment where there's still an expectation that the government will look after us through welfare, but there is a realisation that the government can't look after us because there isn't enough money to do that. So in order to be comfortable, the older you get, you've got to be looking after yourself and your family. So therefore you need to discuss and be prepared to discuss with family and friends how you might go about doing that and how you might put money to one side.
Yeah, very interesting breakdown in terms of how that's changed. That's something that I'd never got my head around. Obviously, only been exposed to 21 years of experience. I've only known that one way of doing things. I didn't realise that it's changed. It's quite a drastic change, I think.
Yeah. I would still say from my experience that a lot of people born in the 1940s and to a certain extent the 1950s are still, they might disclose everything to one or two people, one or two trusted people. That might be an accountant, a financial advisor, that they might share and disclose everything with. But their children, their family, they might never ever discuss their money situation with them. So their family can finish up in a situation where maybe in old age, when that person is going into care, or even post-death after they've died, where the first they know about it, they've got an inkling that there's some wealth there, but the first they really know about it is when the solicitor, accountant, financial advisor is saying, well, this is how much they got. And they're like, wow, because it hasn't been discussed. And yeah, you can speculate as to why that has happened. I've certainly seen a shift, and certainly those born mid-1950s onwards will share more now with their family. Certainly as they're getting older, they're maybe passing money down the generations. Yeah. There's been a significant amount of bank of mum and dad in terms of helping people getting on the housing ladder.
Which is so important, isn't it?
Yeah.
At the end of the day, with inflation and the cost of houses going up, 20-year-olds are looking at it going, how do I afford that?
Absolutely.
And so 100%, I think it's almost been forced into action.
Yeah.
That angle.
So I think there's more conversations within families now, but the biggest challenge we've got, and this isn't just true of the UK, it's a global issue, is there's no education for it for young people. There's nothing in the curriculum around how do you budget? What is money? I remember your brother a few years ago when interest rates started to go up. We'd had an environment where interest rates were virtually nil. So he'd grown up in an environment where he didn't get any interest or very little interest on his savings. And I remember him coming to me and saying, Dad, what's this money that the bank's giving me every month? And that was simply because interest rates had increased.
Yeah.
And that realization that I'm getting paid for just having money in a bank account. How does that work? Now, the realization there is that I'd not discussed that with him because interest rates have been zero, but also there's nothing at a basic education level that teaches you how a bank works, how money works, creating a basic budget, the fact that you can receive money and you can spend money, and how if you haven't got enough money, you can borrow money, but there are consequences. So if you are spending more money than you're receiving, what are the consequences of that?
Yeah.
From a borrowing debt perspective. And then there's the whole myriad situation of different types of debt can cost you different levels of interest, from mortgages being probably the cheapest form of long-term borrowing. 0% finance, the very cheapest form of short-term borrowing, but can cost you if you keep it.
Yeah.
And then credit card debt, which is just off the charts in terms of what that'll cost you in interest. And I don't think any of that's talked about, discussed.
Certainly not when I was there. It was in the school education system. It wasn't really ever touched on. What about the way people looking to invest? Because certainly I've seen, and maybe it's just what I'm exposed to online, but certainly I've seen that these, with the introduction of cryptocurrency and the rapid growth of tech stocks and being able to get pretty quick returns in some cases, and on that's broadcasted across social media. Whether it's true or false is it, whether it's actually been done or not is another matter. But I feel like there's a tendency for people of my generation to see that and almost get fixated on that and chase that, and so they'll put money in this and that, hoping for a 50 or 100x return.
Yep.
And 9 times, let's be real, 99% of those people are going to get their fingers burnt because, as you've already touched on in previous episodes, if you chase it, you're gonna get your fingers burnt. So, have you seen that? And I feel like the majority of your client base is maybe a little older than my generation.
Yes. Yeah.
But have you seen any of that yourself in terms of sort of within? And I imagine people are starting talking about crypto a little bit more.
Yeah.
In your client base and things like that.
Yeah. Most people don't want to go near it because they don't, just from the point of view of understanding.
Yeah. Just not educated on it.
Yes. So we are fearful of things that we don't understand, aren't we? So we get to know them, learn a bit more about it, get under the hood as to what crypto means and the differences between that and Bitcoin and other types of electronic investments and trading. I guess we've been in an environment which has been very positive for investments. So what you often find following a period, and it can be medium, short-term period, but just a period of time where you see phenomenal results, is you get this herd mentality where it's the fear of missing out, I suppose, as well, where they see those returns and think, I want in, I want a piece of that. And that's probably one of the most dangerous environments to be in, because people will have a tendency to pile in rather than blend in or phase in. So they throw everything at it, probably at the wrong time, on the back of a significant upside. And that might be the time to say, get involved, have a little bit of exposure, but just have a look at why it's done so well over the period of time that you're looking at, and what are the reasons behind that. Is it the herd that's all piled in that's inflated the price, or has the price increased positively and there are earnings or profits to support that, that you're going to get a continued return on? And that's breaking down how shares and funds work sometimes. But it's that principle of just, there's nothing wrong with fear when you don't understand. But one of the big mantras, you go back to the kind of Warren Buffetts of this world will say is, when people are piling in and effectively getting greedy, that's the time to be concerned, to almost be fearful. So be fearful when others are greedy. Yeah. Because that's when the sensibility and the review of what makes sense and what doesn't kind of goes out the window, because people do then start chasing the money and the returns, and they go, I want in, well, I want in more, and I want in more. And before you know it, you've created a bubble which pops. Yeah. And the Warren Buffetts of this world have got out well before then. But the people who are new to it, that have piled in, as you said, they're the ones that are going to get their fingers burnt.
And as a result, if price dips and new buy opportunities come, or they've already put all the money in, so they can't
Correct.
collect
Correct.
the new buy opportunities.
That's right.
As a result of
Yeah.
going all in. I think particularly my generation, there's very much a like, let's try and have a bit of fun with it.
Yeah.
To a degree, which I'm all for personally. I think when you're younger, you've got time on your side, and you can afford to take a little bit more risk.
Yeah.
And I think being aware that maybe not going all in on the risky thing is the play, and having maybe 10, I don't know what the figure would be, but a percentage of your money to go, right, let's have some fun with it, see how it works. The rest of my investments, the majority of my investments, are going to be further in on the risk curve, and they're going to be more long term.
Yeah.
Say with a long term mindset. I think when you review like 90% of people who try and trade in and out the markets, if they went against a long term asset that just continued appreciating, their results are probably lower than just buying and waiting.
You've got to be very, very clever or very, very lucky to time the market, because some of the best days come after the worst. Well, how do you know you're at the end of the worst days and that the best days are just about to happen?
Absolutely. It's the whole idea of not shorting the top, or trying to catch a falling knife and send it back the other way. Just if you see a trend forming, then the trend is going to continue. Long term time horizon, follow the trend. In that direction.
The way I would approach it is the highest risk that you take, whatever that percentage is for you, could be 5, 10%, could be more if you're younger and you just want to throw things at it. But even so, that percentage needs to be money that you can afford to lose. So you've got to go in with your eyes open, saying, I could 10 times it, but equally I could lose it. And you've got to be committed to the emotions that you will go through as a consequence of that, and the disciplines that you want to employ by. When you've 10x'd it, do you take some profit or do you stay in? Because it's very easy to say, well, I've 10x'd it, it might 10x again. It might not, it might tank. So do you take some profit and accept that you've made that 10x, you move your profit into the core holding, as I call it, which is your long-term investment fund that will see you right in the fullness of time. And that takes some discipline.
Absolutely.
To do that.
Yeah. It takes a lot of discipline. And it's also being clever about, you could still leave a little bit in there and move.
Absolutely.
Move some. You could even go, right, I've double my money, I take out my initial.
Yes.
Now the trade is all money that I can afford to lose, which I didn't start with. Yeah. Which is sort of something which I've been applying within some of the sort of opportunities I've looked into. Yeah. And I think that's helped. It also helps from a psychological point of view, because you're not like tied down to it, because you've already taken some money out of it. Yeah. So you're not like holding on, hoping that it's gonna go for.
Correct. The psychology of money.
Which can be a risk. Yeah. Absolutely. Yeah. Interesting.
Social media, you've got to be careful of, because there's loads of experts out there, self-professed experts that have been there, done it. Have they really? They might come across as experts. It's very easy. We've talked in other episodes about becoming the person you want to be today. Well, with a good video and a good CV, you can soon set up and make it appear that you've been there, done that, bought the t-shirt, created businesses, created wealth for people, and you present yourself in such a way which seems to be the font of all knowledge when it comes to fintech or crypto. Yeah. So by all means, look at those videos as part of the education, but just be wary of who those people are genuinely. Absolutely. Have they really been there and done it?
I think all of it comes back down to research and information, doesn't it? Yeah. It's the same with don't invest in something you don't know about. Yeah. Don't follow someone who you haven't. And it's easier said than done to get the background info, because they can even blend that and make it look tricky. But I think particularly within sort of the finance industry, you can look at results if it's verifiable results. Yeah. Certainly like hedge funds and things like that, you can go, right, have they have they done, or fund managers, have they done what they say?
Yeah.
And then review the results.
Yeah. And if something looks too good to be true, it probably is.
Yeah.
You always go on that.
Yeah.
The other thing I often get thrown at me, and I've had this for the last 30 years, and it happens in cycles, this time it's different. And there will be differences, but it won't be different. The cycle will continue.
Yeah.
So there will be a pullback. If we're going to talk about investment markets, at some point there will be a pullback from the relative highs that we've got. But that doesn't mean that's the end.
Yeah.
That just means that there's a pullback because it's got overheated, and some of the prices are overinflated. So what will there be a pullback from? That's what you don't know. There might be a sell-off of everything, but there could be a sell-off of certain things, particularly the tech side, that are oversold as a consequence. But then that money's got to flow somewhere. It might go into some of the more traditional businesses that are currently slightly undervalued. So that's why it's important to keep in mind that time horizon, that investment time frame, and appreciate and accept that it's about time in those funds, time in the market, rather than trying to time the market and the ups and downs that we see.
Definitely. I think that's a great principle to take across whatever you're doing.
Yeah. But there are opportunities. You know, that same generation that grew up, that we touched on at the beginning, they were exposed to lots of what was called privatizations, where a lot of public sector organizations floated on the stock market. So they were invited to buy shares, and they saw those shares increase in value. So things like gas utilities and telecoms, back in the 1980s and even into the 90s, there were situations where those sectors were privatized, and literally people could buy shares in them, and the share prices only went one direction. So that was part of the growing up of that generation and getting to grips with looking after their own money, and saving or investing it, the differences between that. So we're in a similar environment. There's similar psychology going on with crypto, because that is an environment where it's something new, and it's something that people can get to grips with, learn about, and see a positive increase. We've only really seen a positive increase.
Absolutely.
In the last 3 years, but people have short memories sometimes. You only have to look at the last 5 years and see where some of those crypto valuations were, and they could go back to there. That's why it's important to keep that open frame of mind. Why are you doing it? Why are you buying it? Are you buying it for the 10x, or are you buying it because you want exposure to a completely different type of currency long term? And should you be looking at something else to just 10x your money? With that small percentage.
Again, information, then, isn't it? It's understanding what's out there, what's available, and having a wider angle view of what you're doing, why you're doing it, and what you actually want to achieve. Because for some people, 10x is, they don't need to do 10x.
No.
You know, if you've got a lot of capital, what's the point in chasing something that's risky?
Correct.
You don't need to.
Yeah.
And making sure it's right for your situation is key, isn't it?
That's right. Yeah. We've touched on the kind of discussion between families, and what I would do is encourage people to discuss finances within families. The education system isn't doing it, so the best thing you can do is have conversations within your family, between parents and children, grandparents, parents and children. Teach them the basics of what money is. You guys never got pocket money, did you? Because I didn't believe in that sense of just giving you money for the sake of giving you money, but earning it in some way, shape or form was the way to go. So if you're getting pocket money, if you're getting spending money, whatever it's called these days, are you just throwing money at your children? And therefore, is there an expectation when they grow up that they're just going to receive money from other places? Or is there a recognition, a realization that in order to receive some money, you have to do something in exchange for that? So their relationship with money then is more understanding around, doesn't just appear, it isn't a helicopter, it isn't a money tree. You have to create your own money tree, don't you? As we've discussed previously. And then from that, you can discuss and explain how budgets might work. Because again, in a family environment, particularly for children, and I would encourage this for primary school age children, if they're earning pocket money, earning money, what do you want to do with that money? Is there something that you're saving for? Is there something you want to spend? So introducing very basic budgeting tips, hints, and explanations from that early age, just to get their relationship with money to be positive.
Yeah.
I remember when I was young, I literally had a piggy bank, and I used to put the coins in, and you didn't see the results of that piggy bank until you opened it at the bottom. But what were you saving for? Sometimes it didn't matter. It was the fact that you were saving money that was the important thing. So anything that went in there was for later. Anything that didn't go in there was to spend. So you're making positive decisions with it. So yeah, encourage good conversations around money, because other people won't. Unless you go to someone like a financial advisor and discuss it. But for the basic tips, I think it's got to be the education within the family.